Hey, everybody. It's your favorite real estate broker, Mark Lima with the Lima Real Estate Group. And I'm here with my preferred lender, Justin from EPiQ Lending. And we are here with another episode of the Mortgage Minute. Today, we're going to be covering interest rates and specifically why they vary from borrower to borrower, lender to lender, and even program to program within the same lender. So without further ado, Justin, go ahead and take it away.
Yeah, and those are all great questions, Mark. So interest rates in general, so for most lenders, most banks, everyone's going to be fairly similar on the interest rate for the most part. You have to be competitive. But on that note, is there are times when some of the bigger banks, credit unions, will move their rates up or down. So an example of that is a lot of the larger banks, when they want to capture a lot of that purchase business, is they go very low or very aggressive on their interest rates. And it's tough for pretty much any other lender to compete. And then once they have all the business they want at that time, they put their rates up to more even keel market rate. And then to add to that is, for all banks and lenders, is, the interest rate is going to be affected by several factors. So if we're talking your general loans, like conventional loans, jumbo loans, et cetera, the rule of thumb for most lenders is you have to have a credit score of 740 or higher to be in that top credit tier, to get the lowest rate. So credit score is by far the number one factor on what interest rate you're going to get. So that's why it's important to keep that score as high as possible, especially when doing financing your new house. Other factors will be is your down payment, or as we lenders call it, loan to value percentage. So the more down payment you're making, that is obviously more attractive to lenders, and that will help get your rate lower. To add to that is, let's say that was on a conventional loan, FHA loans, they are not so credit score sensitive. So an FHA loan, you do not need a 740 or higher credit score to get that low interest rate. So there is a difference between programs. And right now, I would say one of the most popular loan programs around is the bank statement program. So this is for business owners, people that are self-employed, who are making good income. It's just not reflecting that way on their tax return. So instead of using their taxes to qualify for the home loan, we're actually using their bank statements to qualify them. So these kind of more niche loan programs, they do come with a little bit of a premium, which is again a slightly higher interest rate. But again, that helps a lot of people qualify that could not qualify for the home with a traditional loan. So kind of a lot of things going on there, but that's the general reason of why rates will vary between different lenders and specifically between different loan programs as well.
Great, great. Well, thank you again for all your information. You're a wealth of knowledge when it comes to the mortgage scene, as always. So thank you, everybody, for tuning in and watching us again this week. As usual, next week on Thursday, we will be dropping another new episode where we'll go through the same stuff. All right. Have a good day, and I will talk to you later. Goodbye.